All right, today we're diving into a trading strategy that pretty much flips everything you might have learned on its head. It's called the inverse trading strategy, and it's all about finding amazing trades right at the exact moment most other people are getting stopped out.
Okay, so let me ask you something, and I know every trader out there has felt this. You spot the perfect pattern, you jump into the trade, and then, boom, it just breaks down and stops you out. But what if that moment, that frustrating failure, was actually the real setup for an even better trade?
So yeah, let's start with a scenario that every single one of us has been through. It's that moment when those textbook patterns, the ones we've spent so much time learning to trust, suddenly they just don't work. You know, we spend all this time, maybe even years, learning to spot these classic chart patterns, like what you see here. A simple, clean uptrend. Higher highs, higher lows. The books tell us this is exactly what we should be looking for. And then, this happens. The price just snaps back, completely breaking the pattern you were counting on. That nice, neat little structure just falls apart, and suddenly your trade is deep in the red.
And the result? Well, it's that all-too-familiar feeling, right? A loss. Your stop loss gets triggered, you're kicked out of the trade, and you're back to square one. But what if the real trade was right there, hiding inside that failure?
Okay, this is where we need to completely shift our perspective, because the whole idea behind this strategy is that the moment of failure is the actual setup. This quote right here, this is the absolute heart of the whole idea. Seriously, let that sink in for a second. The exact point where most traders are taking a loss and probably closing their charts in frustration, that's actually the start of a new high-probability opportunity.
So what we're talking about here is a total paradigm shift. You have to stop looking at a broken pattern as just a bad trade and start seeing it for what it could be, a brand new signal, a fresh start.
And why does this matter so much? Well, for one, this is an edge that you're just not going to find in most trading books. They all teach you how to trade patterns that work, not what to do when they fall apart. And these failures, they tend to pop up on smaller time frames, and they're especially powerful when they go against the main trend on a higher time frame. That's a huge clue that something big is shifting in the market.
Okay, so that's the big idea. But how does it actually work? Let's get into the nitty-gritty of how you can put this inverse strategy into practice. So here's the simple definition. You're not trying to trade the textbook pattern itself. Instead, you're waiting for it to fail, trapping all the traders who followed the rules. Then you trade the powerful move that comes next, which is often fueled by all those trapped traders scrambling to get out. And to make this super clear, let's use one of the most famous patterns out there as our main example, the good old head and shoulders. Now, this diagram, it shows you exactly what the textbooks say to do. When a bearish head and shoulders fails and breaks upward, the common advice is to buy the pullback to the old peak, the head of the pattern. But look closely at that note from our source material. It says, "This is not my buy." And that brings us to the really clever part of this whole thing. It's not just about trading the failure. It's about being way smarter with your entry point.
Yeah, the person behind our source material puts it perfectly. The goal isn't just to be right about the direction, it's about making the trade as efficient as possible. They're looking for a better entry and a smaller distance to their stop loss. And why is that so important? Because it massively improves your risk-to-reward ratio.
Okay, so let's compare these two methods directly. The textbook way has you buying the pullback way up at the old head. That's a high entry price, which means you need a much wider, riskier stop. But the sources method is all about patience. You wait for a deeper pullback down to the shoulder area, which is a more logical support level. And that gives you a much better entry and a much tighter stop.
And this diagram right here shows you exactly what we're talking about. See that upper level? That's the obvious textbook entry. But the preferred entry is down at that lower support level, the one created by the old shoulder. You're just waiting for a deeper, more logical pullback, which gives you a better price and way better risk control. Okay, theory is one thing. Diagrams are great, but let's see how this actually looks in the real world on a live chart. Let's look at some real-world examples. All right, check this out. Here's a real-life head and shoulders pattern that completely failed. And notice the entry point? It's not at the very top, at the head. The trade is taken on the pullback to the support level created by the old shoulder area. This is a perfect example of this strategy in action.
And you know what? This idea works just as well for short trades, for selling. On this chart, you can see an upward move that ran out of steam and failed. Instead of just selling the breakdown, the strategy is to wait patiently for the price to pull back into this very specific selling zone, a clear level of old resistance. It just gives you a much better entry.
Let's look at one more example on the sell side. A rally fails, and instead of chasing the price down as it drops, the trade is entered when price comes back up to test this key supply level, an area where sellers showed up before. Again, it's all about precision and patience, not just chasing momentum. Now this is super important. Before we wrap up, I have to share the biggest warning from our source. This is not some kind of magic formula. You can't just blindly trade every single pattern failure you see. If you do that, as the quote says, you're going to ruin your account. Context is absolutely everything. All right, so let's quickly recap the main points here. First, start looking at pattern failures as potential opportunities, not just losses. Second, remember that this inverse strategy can give you a much smarter entry than the obvious textbook one. Third, always be aiming for that better entry with a tighter stop to maximize your risk-reward. And finally, and maybe most importantly, none of this works in a vacuum. The bigger picture context from higher timeframes is always crucial.
And that really leaves us with one final question to think about. The next time you're looking at a chart, don't just hunt for those perfect patterns. Ask yourself, what happens if this fails? Because as we've seen, that might be where the real opportunity is hiding. Could looking for failure completely change the way you read the charts?